Capital Discussions Roundtable. This is a special meeting, not on our regular time. I'm Tom Nunemaker with Bill Ghauri, but before we get started, the quick disclaimer, Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And I'm definitely going to have to record that faster, so I can just do the old Charles Cottle routine. So while we're switching presenters, welcome back, Bill. You've been on quite a bit lately. It's always interesting to have you here and see what you're doing with your back testing and research and things.
All right. Well, thanks, Tom, for inviting me back, and hopefully I've got something here that people will enjoy seeing. Let me take the screen here so that.
Yep, you've got it.
Okay. All right. Okay.
I see your screen.
Okay. Let me get the slideshow started. Okay, so you see the slides?
I do.
Okay, good. So what I was going to do today is I've been working on a model for the past few weeks that will systematically look at different spreads and evaluate the risk of those spreads and the price of those spreads, and to kind of, because I've had this idea of rather than just kind of having some arbitrary rules in terms of selecting spreads, that maybe there's a better way. So I've put together something that I think people might find interesting. First, I'll give a little disclaimer here. Options, of course, involves the risk of loss. It's not suitable for everyone. Past performance does not guarantee future results. And this is my experience, and your experience may be different. So the presentation today, I only have, I think, 8 or 9 slides. I'll give you 3 concepts to think about. I'm going to talk about how I rank spread risk. Then I'm going to show some spread combination tables, how I filter those spreads, and then how I use linear regression analysis to sort of pick the ones that have the best bang for the buck. And then what I'll do is I'll do a real-time demo of the model, and the good thing is since the market is open, we'll be able to select some spreads real-time. So here's the concepts to think about today is that consider perhaps taking a systematic approach to choosing spreads. As you know, when it's time to sell spreads, and I'm not going to talk any about technical analysis in this presentation. I've addressed that in the 2 previous presentations about using technical analysis. So this is sort of like the next step. After you've applied your technical analysis and you say, hey, it's a good time to be selling premium, this is sort of the next step. So when it is time to sell spreads, when it's time to sell spreads, what you're of course looking for is you want to sell the spreads that give you the highest premium for the lowest risk. I mean, obviously that's what you want. So with that in mind, one of the things that I'd like to say is that you might want to change your mindset that spreads have to be constructed and selected a certain way. I mean, most people, I think, will take have some rules or guidelines to say, hey, I want to sell a spread, and the short, I want a delta of about 15, and then I'll do my long maybe 20 points or 25 points below that, and that sort of becomes their rule. Well, that may not be the best spread. So when selling credit spreads, whether it be puts or calls, I mean, it's pretty simple. You're selling an option that's close to the money or closer to the money, that's your short, and you're buying an option that's further away, that's your long. So to me, I define there's 2 primary risk components to a spread. The first one is the delta of the short strike, and then the second one is the distance between the short strike and the long strike. And that distance is, most of the time we refer to that in points, but also you could look at it in terms of the difference in deltas. And so I sort of use these two components to be able to rank a spread in terms of its risk. And quite simply what I do is I view that the highest risk component of a spread is the delta of the short option. Therefore, I weight it more, whereas the spread width, which also I use as in defining the risk, is the absolute difference of the deltas between the long and the short. So I came up with this formula. It's pretty simple, and all I do is I square the short delta, multiply that times the delta difference, and I take the square root and multiply times 100. And what this does is it gives me a risk value for a spread. And the purpose of this really is just to give a numerical value to a spread so that I can rank spreads by price and risk. Now, of course, these are all going to be spreads within the same expiration date. But the higher the numerical value, the higher the risk. So what I do is I create a table, and this is a real-time snapshot that I took from the model. And what I do is I create a table of all the potential spread combinations that one could look at. And starting with at the money and then going on down. So, for example, this is the beginning of the table, and at the time 2070 was roughly at the money when I did this snapshot. And so you can see the short strike here, the short delta, the short open interest, the short mark or mid price, then the long strike, long delta, long open interest, the long mark price or mid price, the width of the spread, the delta difference, and then the spread risk ranking that according to the formula, and then this is the spread price. So if we look at this first one here, we have a short of 2070, we have a long of 2060. That's a 10-point wide spread. The delta difference on that was 0.04, and if you go through the math, it came up with a rank of 9.2, and the spread price on that was 380. So you see here, these are all 2070, and then we have 2060, 2050, 2040, 2030, 2025, 2020, 2010, so on and so forth. And so these are all the different spreads. And so you can see, obviously, as the width of the spread goes up, the spread risk value goes up as well. And then, obviously, the price goes up as well. And so it'll go through every increment of the strikes and create a table. So what this produces is a table with several hundred potential strikes. And like when I do the SPX, I think it comes up to maybe 350 or so potential spreads. So obviously that's too many spreads to be looking at, so we need to filter that down. And so what I do is I apply some filtering criteria to get it down to a population of spreads that I can work with. And one way, for example, is the puts, looking at something with a delta of, say, 20 or less. Maybe looking at a spread width of maybe, something 50 points or 75 points and under, maybe even 100 points and under. But, you want to filter it down. Maybe you're not interested in looking at anything that's over 100 points wide, just because, you may not want to be looking at something that wide. You may want to also look at a minimum spread price, so that you're not looking at spreads that have a price of, say, 40 cents. That's something you're not interested in. And then minimum open interest, which of course is, I think, very key, is that you have to be looking at strikes that have a decent amount of minimum open interest, because otherwise, when you start looking at strikes that have very low open interest, the bid-ask spreads get wider, and it becomes then an issue of where you're likely to be filled. So you want to do some liquid stuff. So if we applied the filtering criteria to that previous spread table that I showed you, then we come up with a smaller set of filtered spreads, and this is for puts that for the SPX that when I ran this for these slides. And so you're looking at that and you go, okay, all right, well, I can see I've filtered it down now based on those parameters that I showed. So now which one should I sell? Well, I can give you a hint here. The one with the arrow is not a bad one to sell. And you're thinking, well, how you know, why would I want to sell that spread over another spread? Well, once you once you do get the spreads ranked and by spread price, at that point you can do a little linear regression analysis and plot those spreads to say, hey, you know, which ones are giving me the biggest bang for my buck. And what's interesting about this is that I did not expect to see as much variation as I have when I first started, you know, analyzing spreads in this fashion. I thought that risk and price were, I mean, risk and price, of course, is linear, but it's those small differences that can make a pretty significant difference. So, for example, if we're looking, this is the linear regression analysis for that previous table that I showed. So you see the straight line, that's our linear regression line of that of that set of spreads. And if you notice here, for example, this is the spread that I noted with the arrow that this might be a good one to sell. Well, notice the spread risk valuation number for this spread is 3.5, and you're getting $4.50 for that spread. So if you were to look across here and say, hey, here's a spread I can also get for $4.50 for it, maybe I should sell that one. I don't think so. I would rather sell this one here. And the reason is it has a lower spread risk as opposed to this one here. And so remember, spread risk ranking, or the spread risk value, the higher the number, the higher the risk. So clearly anything above the linear regression line is going to offer you a better price for a lower risk. I mean, for example, you could be looking at here, and we have spreads here that are, somewhere under 350, maybe that's around 340 or something. And then here's one for 350. Quite a bit difference in the spread risk. So which one would you sell? You'd certainly sell this one over this one. So that's how I use the linear regression to determine which spreads. And so that's I think that's all the slides I have. So I'll do a demo of the model. I call it my spread analysis model, and that I think is when we can kind of go through this and you can see it live, and it might make a little more sense. So with that, let me actually, I haven't opened up the model yet. Let me get that going. Go full screen. Okay. But are there any, I'm not looking at the questions thing, so I don't know if there's any questions at this point.
No questions yet, Bill.
Okay, let me move this screen over. Okay, there we go. Okay. I'm moving a bunch of windows around here on my other monitor. Okay. So here's the model, and like most of my models, everything is generated by code. I don't have any worksheet formulas. In fact, in this entire model, there's not a single worksheet formula. But what I'll do is I'm going to create a new model for the SPX. So, because that's the one that I typically look at, and I'll use the May expiration, I'll do puts. And so when I do that and I set that up, what that initially does is it sets up real-time pricing RTD formulas that bring in real-time data. So once I have that, then I can generate an option table, and this is a table that's now live of options, and it starts at the money, and then I do it in 10 and 25 point increments. So you can see here the SPX is currently trading around 2081, and so I start here at 2080, 2075, 2070, 2060. So these are basically just the options. You can see the percent out of the money, so I'm going from basically at the money to, this is about 11% out of the money. Here's the Oprah code for all those. The probability of expiring for the options, and this is all live. And the deltas, now of course you know delta is basically a proxy for probability of expiring. The theta, vega, IV, open interest, bid, ask, mid. So now I have a live table coming in with option data. So, but one of the things I want to do here first is just to, I mean, I know everyone is kind of done, you know, similar type of things, but I want to, I don't know why I'm not getting a price there on that last one. Maybe it's not. I tell you what I'll do. Go down to here. What I want to do is I want to show, first off, I mean, this is, everyone kind of knows that delta and price. So for example, here's delta on the lower axis. In fact, actually, let me do this. Here's delta on the x-axis, and then here's price on the y-axis. And this, of course, is at the money here with a delta of around 50, going down to around a delta of 5. So everyone knows there's a linear relationship between price and delta. This isn't anything new. Everyone knows this, okay? So, but I want people to kind of start thinking in terms of the risk associated with how close something is to the money. When I say risk, to me it's all about probability of expiring. Because, for example, if you're selling here, let's say this is an 1850, it has a probability of expiring of 4.5%, or around a delta of 4. This has much lower risk in my mind than selling something, say, up here, obviously. I mean, obviously, the further you get out of the money, the lower the risk of it expiring in the money. And since we're premium sellers, our goal is to sell premium, but hopefully it expires out of the money. So this is why I weight the delta highest in terms of the risk factors in my formula. The short delta to me carries the highest amount of risk. And so this chart here is just a very simple graphical representation showing that risk, the price delta relationship. So like I said, nothing new. So there's other relationships too that, it's kind of fun to sort of look at, but like one of them is to look at the bid-ask spread difference compared to open interest. You'll notice that there's a definite correlation between higher open interest has lower bid-ask spreads. However, the further you get out of the money, the wider the bid-ask spread gets. So those are some interesting things. But anyhow, let's move on here. So once I have my live prices coming in, the next step is to create the spread table. Now this table now it's about 350 or so possible spreads. And so we start here at the money, and you notice it just changed just from the time that I started this. It was 2070. I think it's now 2075. So here we go. Here's our short strike at 2075. Here's our long at 2070. That's a 5-point wide spread. So we look at, here's all the 2075s. And here's the long strikes going from 2070 down to 1875. So we have spread widths here going all the way down to 215 points wide. So we start at 5 points wide, go to 215. And now we go to the 270. So we go 270, 260, 270, 250, 270, 240. And then we go through all those. And then we go through 260. And then we do 250, and we go on. And so you can see just the iterations of them, you end up with, in this case, 351 spreads. Now, all of these spreads are ranked by the risk formula. So we have a numerical value now that we can assign to those spreads. So the next step that I do is I apply some filter criteria, and for example, I'm going to just filter these just to say, for example, since these are puts, if I were looking at selling a put spread today, for some reason my technical analysis said, hey, this is a good time to be selling some put spreads, which it's actually not, but that's, for the sake of the discussion, we'll assume that we're selling some put spreads here. I would be trying to figure out, okay, well, which spreads do I want to sell? So this table represents 350 potential spreads that I could consider selling. Obviously, I'm not interested in all of those. I might say, well, I don't want to look at anything with a delta greater than 20. So I might filter it down to say, let's look at stuff that's at least has a delta of 20 or less out of the money. Also may say I want to look at stuff that has open interest, greater than 1,000. So that helps us. Now the spread width, maybe it's 100, maybe it's a little less. Maybe I put in, I'm just going to put in just kind of, maybe I'll say 70 or something. And I want to look at spreads that are greater than $3. So once I decide what kind of criteria I want to use to filter the spreads, then I can apply the filter and then get a table of spreads that are a little more reasonable range to look at. So now, if you recall, we had looked at strikes that had a delta of 20 or less, and you notice that the short delta, there's a 9, a 10, a 10, a 10, an 11, 11, a 13, a 13, a 14, a 15, a 14, a 13, so on and so forth down here, an 18, a 16. So yes, it filtered it, by short delta. Also on price, we said $3 or more, and so all these are $3 and more. The open interest on both the short and the long, we said over 1,000, and these are all over 1,000 here. And same on the long, over 1,000. So we have a better range to work with. So once I have actually filtered that down, then what I do is I apply the linear regression analysis to it. And so now I've applied the linear regression analysis to it, to this set of spreads. And once I've been able to do that, then I can also look at the chart. So here's the chart. So now when we look at the chart, we're looking at, we can clearly see that there's some spreads that are a little better than others. So the way I rank them is actually the distance from the linear regression line. So if it's a positive distance, like for example, this one I can tell you is a pretty highly ranked one. This one is probably a pretty highly ranked spread. This is probably going to be the worst spread right here, because look at the distance from the linear regression line. So that one at 340 is a lousy spread to sell. This one here at 440, that's a good one. So this gives you a visual here, but you can actually look at the table here because it's ranked by, once I apply the linear regression analysis, it's ranked by distance. So for example, here's a spread here that at least for the best bang for your buck, this one is a very good one. 630 is the spread price. It did have a rank of 5.7. It is a 70-point wide spread, and it does meet our requirement of being a delta of 50 or under. Now, we may not, while we filtered it based on a maximum spread width, maybe we're looking at something, we want to look at something a little less. So here's the thing about this, is that we don't just have to pick the highest distance spread. We have, actually here, let me backtrack a little bit just to go back to the spread table. Let's just say we're going to sell a put credit spread, and you said, okay, I'm going to sell with a delta of 20 or less, and I'm going to do something, say 50 points wide. Just arbitrarily, that's what you're thinking is the best bet. And so if we looked at something here, how about a delta of 20 or less? Here's a 19 at 1990, but here's a 2000. Okay, we might say, well, 2000, that's, look at the open interest, it's very high. We like to do 25-point increments. Maybe that's a good one. Maybe we do the 2000, the 1950. So you might be thinking that maybe that's a good one to do, 2000, 1950, because it's 50 points wide and you're going to kind of arbitrarily go with that. Well, of course, this is live. I haven't looked at this, but let's just say if that was the one that you were looking at, well, it actually didn't come up because we filtered it by, okay, that was a little over the delta. So, well, let's just say here, 1975, 1925, there's a 50-point wide, okay? Short delta of 16, and the 1925 has a short delta of 9. So if we had said that we're going to do that spread, how does that spread compare? Well, if we take a look and we try to find that spread, there's a good chance, okay, there it is right there. So that spread, in fact, let me just kind of highlight some stuff here. That spread right there, we could sell that spread for $4.15, okay? It has a risk ranking of 3.9, okay? And our short delta on that is 15.4. So if we went into this exercise thinking, okay, I'm going to do a 50-point wide spread, and I'm going to choose that spread, I can probably find you another spread here that's going to not only give you a higher credit spread price, you're going to receive a higher credit, but at lower risk. It may be a little wider, but let's just see. So we have 415. How about, here you go. There's our spread. There's a better one right there. I would rather do this one right here. I'll tell you why. Okay, look. We can sell this spread here. It's a 1970-1900. Now it is slightly wider, but notice our short now has a lower delta. I would rather sell a 14.5 than a 15.4. I get more premium. I get $4.80 versus $4.15. So right there tells you that there's a better spread to be sold. You can look through your table and through this analysis, find spreads that offer a better price to spread risk ratio. And so that it's just a matter of looking at your spreads in a more systematic way. And this is what's kind of interesting about this, is that while there's a definite linear relationship between the spread risk and the price, you see enough variation that you can easily find spreads. You know, you can optimize the spreads that you sell to get a better price. And in this example right here, that's a pretty significant $4.80 versus $4.15. That's pretty significant difference.
Bill, we've had a couple of questions while you're talking. Thomas asked, can you run the linear regressions in Excel? And I guess that's a yes.
Yes.
Andrew Stan says that we know that the assumptions that go into option pricing models underestimate tail risk. So do you think that there's a maximum strike difference that balances return versus extreme risk?
Yeah, you know, I do. And I think you do find that, in fact, let me see if it's, which one I did. I think it's, this is kind of an interesting chart.
Well, you do that, Andrew, I'm going to challenge your statement. You read that in a book about the way models have been for a long, long time. But one of the things that's happened quite significantly over the last couple of years, and specifically over the last 2 quarters, is that the put skew, the implied volatility of the puts below the money have gotten steeper, meaning more expensive. Okay, therefore, when you take a look at what Bill is doing, it's more important than ever to make sure that you're selling your put spreads at the specific part of the curve that will end up giving you the most amount of money for the least amount of risk. What we do at EAB is the exact opposite thing that Bill is showing you, because we have to protect portfolios. So we're looking for downside protection. I can tell you that when we put our protection on in both January and February, we were looking at buying, not selling, buying put verticals instead of our standard way that we would end up hedging, because that put skew, the implied volatility below the money versus at the money, was so different. We were at a 3 standard deviation move in terms of its pricing over the last 2 years that it made it much, much cheaper for us to buy those put debit spreads as protection. So when Bill's going through this, you, meaning the retail trader, have more of a need to do this type of analysis than you've ever had before. The concept of just being able to sell put spreads and make money most of the time is behind us. Okay, so if you're not educated, knowing how expensive these put spreads are and when you should be selling them versus if you should be buying them is absolutely critical. Bill, I'm sorry, I just wanted to end up saying that because I think it's so important that all of our listeners end up having the proper background to understand and appreciate just how important this work is that you're doing.
You know, Jim, you bring up an excellent point that I kind of actually should. In fact, I'm glad you brought it up, because this whole presentation has been focused on selling credit spreads. You know, which ones give you the best bang for your buck. But of course, the same principle applies in reverse. If you're buying a put vertical, which one should you buy? It's the same thing. You would be looking at stuff here that is cheap. And so you could apply these principles of linear regression analysis in reverse for put verticals or call verticals that you're a debit spread that you're buying. So you bring up an excellent point. So, but that one of the things that I was going to show here
I was on mute. I said, of course I did. I said you were doing a good job.
Okay. So this is what I think is kind of an interesting chart, and it's, if you look at all of the potential combination of spreads and you look at the linear regression of those spread prices versus spread width. So for example, here, I'll do this. Okay, that's spread width. And then this is spread price. Now this is what's a kind of an interesting chart, is that you'll notice that spreads that when you're in that kind of roughly 100-point wide range is kind of when it's the fattest. You see the widest deviation, I suppose. And I'm not sure really what to tell you, what to make of this, other than there probably is, you would not want, at least, you probably wouldn't want to be looking at spreads much wider than around 100 points wide, is what I would draw from this chart. When you get beyond that, then you're losing a lot of, well, I just say that I think that spreads, and in my experience of playing around with this model thus far, when you go beyond 100 points wide, they tend not to be the best spreads from a price risk standpoint. I guess a long roundabout way of saying that. So
two things, right? Number one is the risk, but also number two, what ends up happening is that the difference in the put skew at that point is starting to affect you very negatively because you're so far apart. The IV of the put that you're selling is going to be significantly lower than the IV of the put that you're buying. Correct. So those two factors together make the risk-reward ratios a little bit more challenging. One of the things that you'll end up finding that when we're protecting portfolios, those are the ones we'd love to buy. We love to buy 100-point wide spreads.
Oh, yeah, exactly. And you can, I mean, again, you can apply this analysis in reverse if you're looking. I mean, clearly what you would do is you would be looking at those strikes down on this end of the thing. These are the ones that you want to buy down here. These are the ones that you want to sell up here. So so that's just kind of it. It's a fairly I mean, the concept of this type of analysis is actually fairly straightforward and simple. It's the execution of it. It does take a little bit of doing, but I think it's a worthwhile thing for people to think about. That just having arbitrary rules to say, well, I'm going to sell a delta of 10 and I'm going to do a 20-point wide spread. To me, that's fairly. I mean, there's some guidelines there. You're specifying the delta of your short, but just to say it's going to be a 20-point wide spread, that's arbitrary. To me, that is totally arbitrary, because you may find that maybe you can sell a delta of 8 with a spread width of, say, 30 that's going to give you a higher premium at lower risk.
Hey, Bill, Evelyn asks, why not show price divided by risk on your table and use the highest number? Have you looked at that?
Yeah, price divided by risk. I haven't done that. I could do that.
And your risk calculations also include in distance between
the distance between the strikes. Yeah,
it does include it. Okay.
Yeah, that's this formula right here. Spread risk equals the square root of the short delta squared times the delta difference times 100. That's the formula that I'm using. So you can see I'm weighting the short delta higher than the delta difference. But the delta difference, or the width of the spread, of course, is a component that I look at.
Okay. Two very quick points. For those that you don't know, Evelyn, the lady who just asked the question, is a PhD in math. Okay, so of course she's going to end up asking questions like that. And Evelyn, in the quantitative model that we end up using at EAB, we use different formulas and we're doing different things, but the approach is relatively the same, and we do exactly that. We have a model where we're looking to end up buying the most protection for the least amount of money. Our model's a lot more complex because the thing is that we'll end up using diagonals and extra calls, and so we have, you know, a whole bunch of different hedges that we're looking on the downside, but that is exactly what we do. Once we end up having our mathematical probability models in place, we take a look to see which one's going to end up, and here we should be doing the exact opposite, right? Which one's going to give us the most amount of money for the least amount of risk that we're taking.
I noticed another question here about volatility differences between strikes. You know, I did look at that as one way of potentially ranking the spreads, is the difference in the volatility and kind of incorporating that. But I actually took that out. It would have been here. I was looking at that, but I just, to be honest with you, I could not come up with a formula that was as simple and elegant and as effective as that simple formula that I came up with. And you know, I have to say, it's such a simple formula that I'm sure someone else has used that before. I mean, it just seems to me a formula like that has been used before. Could it be improved upon? I'm sure it could, or I'm sure it can. But for my purposes of coming up with a tool that would allow me to be able to look at spreads and kind of like pick out the best ones, this is what I'm using. But again, I've been amazed at how much variation that you do see among spreads. And interestingly, the spreads that you see, the more standard width spreads of, say, a 25-point wide spread in like the SPX and the NDX, or a 50-point wide spread. Interestingly, those often are the worst performing spreads. And I think part of it is because that's the spreads that most retail traders gravitate towards.
Hey, Bill, Robert had a question. Does the spread price divided by margin percentage enter into your analysis, i.e. the use of capital versus premium?
No, there's no, that's not part of it. I mean, what goes into the analysis is this is purely a mathematical exercise here of looking at the deltas of the short strike, the absolute width of the spread in terms of deltas, and the price of the spread based on mid-price, and then applying linear regression to the spreads that you're looking at, and then looking at those that are above the linear regression line and those that are below the linear regression line. I mean, that's, like I said, it's just really a mathematical exercise. But it's quite revealing when you start looking at which spreads are you going to sell. Now, there's another value to looking at spreads this way as well. As some of you may know from my previous presentations, I sell naked SPX puts and sometimes calls. Well, when it's time to roll a put because it's hit a stop multiple or roll multiple, what I look at is, rather than just rolling it down a set, say 25 points, I got the, like the 1950s on, and it hits my stop multiple, and I say, well, I'm going to roll it down to a 1925. Well, now I'm not using just a a fixed increment to roll it down to. I look at the potential. I look at that as a potential spread now, because now I'm closing out and rolling with a spread, because I'm buying back the short and selling another long. So now I'm looking at what makes the most sense, and often it will not be just a flat arbitrary 25-point wide roll. Maybe it's 30 points, maybe it's 15 points. It's, you don't know. I mean, you have to kind of do the analysis to tell you which one gives you the best bang for your buck, or in the case of rolling, which is your lowest cost roll to get you as far out of the money as you can get. So this analysis or this method of analysis has a lot of value, in my opinion. Whether you're hedging and you're buying spreads, or if you're selling. So and that goes back to the beginning of the presentation, where I said, kind of might want to consider applying a systematic approach to choosing spreads, and also changing your mindset that, it just doesn't have to be constructed and selected in an absolute, way. I mean, you kind of give yourself a little bit of flexibility, and you might find you can get a lot more premium for something that you hadn't even considered before.
Hey, Bill, Andrew asked, have you compared the prices in the spreadsheet versus actual bid-ask prices to those spreads? And I think this is all real time, though, right?
Yeah, this is a real-time chart. This is streaming in real time right here.
And then Jay asked, in the formula, are you multiplying the delta by 100 before squaring?
No, I do it's the square root of the short delta squared times the delta difference, and then you take that value and you multiply it times 100.
Okay, I think we're caught up on the questions.
Okay. So that's it.
Right. Jim, any last comments or any other questions from the attendees? The last chance before we call it a day.
The last comment that I would end up making is that, I've seen a lot of different strategies. And Bill and I had spoken a lot about this. I think that the approach that Bill has put together here is probably going to be the one that is, I'm going to say, the most popular, in the sense that I think it's the most useful. It's the most useful in two places. Number one, it's kind of like a back to basics. If you're going to be putting on a butterfly, what are you doing other than buying a vertical and selling a vertical? Okay, and what Bill is doing is he's taking the most basic type of, building block. If you think about, all we have in our toolbox is 3 building blocks, right? We have verticals, we have calendars, and we have singles. Okay, you can buy or sell any of them. You put them together in any structure you want, and you can build the most complex set of inventory you'd ever imagine. So taking this very detailed look at a basic trade, I think, is one of the most critical things that you can end up doing. If you think about some of the greatest coaches, okay, in the history of sports, what they ended up doing is that they would have their players just practice and practice and practice basics. This is one of the things that you must master. The thing that I love about the way Bill's doing this is that he's also wrapped around some really good risk management principles around this, about here's a good time to get in, and here's when you should be getting out, or here's when you should be getting in. So the risk management principles, and Bill, I know you've shared those in different areas, not today, but I think that these things wrapped together end up being probably the most useful exercise any of our listeners could ever use?
I think there's a lot of applicability for the just as you said, these principles that I've presented here, because like you said, there's basic building blocks that a lot of us use for constructing our positions. But if you get back to the basics, and also I think too, change your mindset a little bit, kind of open up your mind to think, don't think in such absolute terms, but think in terms of, when I say absolute terms, that for example, a spread has to be constructed a certain way. I always do 20-point wide spreads. That might be someone, I sell a delta of 10 and it has to be 20 points wide. Well, change your thinking about that. Maybe one month it might be 35 points wide and another month it might be 15 points wide, because those are the ones that gave you the best bang for your buck. So it's a change of kind of expanding the way people think in terms of how they put on positions, because as you said, Jim, there's these basic building blocks that we have to work with, and so it doesn't matter what you're trading. Now, you can be doing iron condors, broken wing condors, if you're going to be doing, say, a weird door, for example, and you're putting on a spread, you're selling the put credit spread, rather than just using some rules that restrict you to what you think you should put on. Maybe you should be thinking that, hey, I want to sell a spread. My quote rules tell me I can sell this spread for $2, but maybe if I expand my thinking about this, maybe I sell a completely different spread that I was thinking about, and maybe I get $2.25 for it, and I have lower risk. So I think there's a lot of applicability to all types of different trading strategies.
Last question, I guess. We had somebody say they'd love to have this for their own trading. Do you have any plans to make this available to people in some form in the future?
Possibly so. What I would do, as you can see, it's a pretty user-friendly model. You can create models and, set up different, I just have it doing NDX, RUT, and SPX for now. But it's fairly automated. It's all done by code. Possibly so. I find it to be an extraordinarily valuable tool. And the other thing is that, even if someone were thinking about applying this type of analysis to their own trading, to be honest with you, you would have to come up with your own model to do this, because this is the kind of math that you can't do manually. It's just not possible. Kind of like automated back testing with options. It's you kind of need to really test hundreds and hundreds of different risk and money management plans and different parameters. You can't do that manually. You have to have an automated tool. I'd say the same thing applies to doing this linear regression analysis on spreads. So you kind of need to have a tool to be able to do that. But there's a lot of sharp programmers out there, I'm sure, that could probably put something like this together. But yeah, I think I may put together an XLL type add-in that could be distributed, but we'll see. We'll see. I think it depends too on, if there's enough feedback that this is something that people are interested in, then we'll see.
All right, very good. Well, thanks very much, Bill, for joining us again. Always interesting to have you here. I love to see what you're doing.
Sure, yeah, and I guess if anyone needs to contact me, my email address is the best way. And yeah, well, good. Well, I'm glad everyone or people could make it, and So we'll
Well, I guess with that we can end it, and I'll get this recording posted in the archives as soon as possible. So thanks
Okay.
everyone.
And and Tom, I'll send you the slides so that people can have the slides at least.
Okay, fantastic.
Okay.
All right. Thanks, everyone. Bye.
Okay.
Thank you so much for sharing.
Okay. All right. Talk to you later.
Thanks.